Today we're looking at whether COVID 2.0 is on the horizon, as we're seeing some cases of a weird virus picking up in China and in some parts of Asia. And then we're looking at gold. It's back above the 200 daily moving average. Where does it go from here? And the Trading Takeout today is to understand what currency pairs are sensitive to so that you can build a better picture of what you're trading. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So there's been reports lately of a new illness cropping up in China. And yeah, it's terrifying to think about, considering what happened to the state of the world back in 2020, 2021, and even into 2022. And, we're still feeling the effects of it now. But you can see here that there's this new headline that's come up. China says multiple pathogens are behind the surge in respiratory illnesses in China and not by a novel virus, which is good, I guess, but still, I don't like the word pathogens. The problem here that I see, though, is there will be any excuse for central banks to cut interest rates and to keep money circulating around the economy, basically, especially now when we're seeing slowdowns occurring. And I can point to, there's kind of a context here, especially related to China. So here at 6:55, another headline came out. Cash conditions within China's money markets displayed signs of tightness on Monday via Reuters, as participants became cautious around month-end demand given the recent liquidity squeeze. What that means is basically the Chinese markets, are facing illiquidity right now. And there's another headline here from Barclays that says that the month end, there should be some month end selling in the dollar. Let me see if I can find it. Here we go. Barclays FX month end, strong USD selling against most majors. So ideally, China wants that to happen. If the dollar comes down, it reduces some illiquidity in Chinese markets. But, and there's another big but as well, there are economic conditions here too. So if we scroll down to, let me find it again, sorry. There is a story that came out. Here we go. Chinese industrial profit. Year on year, 2.7%, previous 11.9%. Year to date, negative 7.8%, previous negative 9%. So industrial profits are declining in China as well. There's no demand. Why might this be? Well, we can now combine the tightness in money markets, combine all of these different factors together and say, well, one, higher interest rates on aggregate globally are affecting demand, which means that Chinese profits are down. Two, we can see that the dollar, being pretty bullish since the start of the year, is also creating a bit of a liquidity squeeze. And then obviously we've got the natural, causes of what's going on globally with just the demand business cycle. These are all factors that, when it comes to changing monetary policy, something like a virus looking bad on the horizon, central bankers can go and say, oh, well, we think that demand's going to get absolutely smashed from this. We're not going to return to COVID, but we need to do X, Y, Z. We're not going to return to lockdowns, etc., but we need to do X, Y, Z, i.e. print more money, cut interest rates. It's a far out thought, but the far out thoughts are what let you have home runs over the year. Okay, if you're positioned for something that not everyone else is really positioned for, it means that there's greater risk to reward in that trade. So it's definitely something to pay attention to, this story with regards to the pathogens. There's no appetite from the general public, I don't think, for lockdowns, or at least my little section of the general public anyway, that might be a little bit more rational. But do we have rational governments? No, we have governments that love to fall to the loud minority, if you like. So if this does start to kick up a bit more of a storm, if we do start to see, more hospitalizations, etc., I wouldn't be surprised for it to take a bit more of a center stage in the news cycle, and even into economic thinking as well. Now, I mentioned gold a few weeks ago, and I want to revisit it again because for me, it looks like there's a really strong technical base sort of forming here on gold. Now, if we just follow some simple technicals, you can see a couple of things. So let's just highlight them. Firstly, there's a bit of a sort of cup and handle. Okay, as you may know by now, I'm not that huge on technical patterns, but the macro kind of backs it, which is why whenever I talk about technical patterns, it's usually backed by some sort of macroeconomic view as well. Cup and handle, if you measure out this kind of line, you probably get up to here, which is quite interesting. You've also got the 200 daily moving average, which we've been through. Let me actually delete that because there's another little part here. So the 200 daily moving average, which obviously we are through just here. And interestingly, right when we came back to test, we had this big old doji pin bar as well, which is always lovely to see when you're looking at a sort of rejection. Key parts for me would be breaching above 2030 with then an extension up to 2150-ish. Let's say just here actually, which is more 2140. It's called 2140. That is really what I'd be looking for, and the play would be something like that. You know, obviously there's loads of stop-start in between, but that is really what I'm looking for. Now, the key here, though, is that people are still expecting further dollar weakness, and I can kind of see it. I can definitely see it, especially with dollar strength. Especially with equities strength looking into year end. Deutsche Bank came out today and said they expect equities at 5,100 by the end of 2024. So that's quite an extension there. We're currently at 4,500, I think. So 4,500, so that's 600 points higher. A year off, that's a bit much for me. I don't really like to predict that far ahead. But lots of calls for bullishness from pretty market savvy people. I don't like to say smart people because smart doesn't always mean that you're actually good at markets, but market savvy, they've got a good gut feel. Whether that happens or not is another story. Now, the other key component for me is that gold can behave very nicely in a risk-off scenario. So if we are expecting, broader declines in economic perceptions, economic confidence, that kind of thing, then you could probably expect bonds higher, interest rates down, gold up, real rates down. Real rates behave in an inverse to gold. So if real rates are down, then gold increases in price, and vice versa. If real rates are up, then gold declines. So that's really the macroeconomic backing to the technical pattern here. And I like to keep things relatively simple. You've got a double pattern there. You could even argue, excuse me, if you were to zoom out a little bit more, you've got this big low break, the 2023 low break. You've got this, if you were to put this onto maybe a quarterly chart, let's have a look. It should look like a big old pin bar. That's not a quarterly chart, but we'll run with it. Let me just remove these. 3 month, there we go. Maybe not 3 months, let's try 1 month. No, not quite, but this is bullish enough. If you can see this is the sort of October-November candle here. It's a outside month, if you like, which tends to be very bullish. So we've got, or even a bullish engulfing, I probably should say. I don't know the failure rate on that. It's probably just below, 50%, which is good enough for me. So you can see that this is a bullish impulse candle basically here, and then you've got the target up there that we mentioned of 2140-ish. So some nice backing to it. I'm not going to say it's foolproof. No traders are foolproof, but you've also got a lovely support level here, over-under sort of play. So, there's a couple of things there, and all we're looking to do in trading, of course, is put the odds in our favor. Couple of components there to keep the odds in our favor, keep your risk tight, keep your risk small, and scale in once it starts going your way. It's probably the best advice that I can give. Now, you might notice that I talk about macro quite a lot, and there is good reason for that. Now, my background is traditionally in FX. It's what I know quite a lot about. And the reason why I love FX is because it encompasses everything. So any kind of flow between assets, it really, really is sensitive to. And this is what I really want to talk about today. It's what currencies are really sensitive to outside of the normal bond yield spreads and interest rate differentials. So we've kind of got like a few different types of currencies. We've got risk on currencies, risk off currencies. The risk on currencies tend to be very, very focused towards commodities, towards equities, and that kind of thing. And the risk off currencies tend to be very defensive based on their domestic geopolitics, perhaps. So if we take the Swiss franc, Switzerland is traditionally a very neutral country when it comes to geopolitics. So whenever things are kicking off in Switzerland, there tends to be a flight to the franc. The same with the yen. The yen is also relatively political neutral because of Japan's stance in the world. So geopolitics come into the strength of currencies. Then you get commodity currencies such as, the Canadian dollar. Canadian dollar is very, very sensitive to oil. Aussie is very sensitive to metals. So you've really got to focus on what the commodities are doing and how that might influence FX, the same as everything else going on around you.